Hello, friends. Welcome back to my YouTube channel. Tell me how many of you feel overwhelmed by this investment terms, like all these jargons, and you just don't understand different words used by different mutual fund manager, different products. But there's this one word that you keep listening: SIP, NAV, CAGR, ETF. Does all these words, when you hear them, does it make your head spin? Then this video is for you because I'm going to tell you, relax, you are not alone. There are many people who are struggling with such words. And most people, they don't fail at investing because they are lazy. Most people fail at investing because it feels so confusing and embarrassing to talk about. It becomes very difficult for them to even understand these terminologies on their own. It confuses them and it makes them lose their lovely sleep. So let's see how these terms can be made easy in today's session. So I would say if your money story is not over, this is just a starting point because picture abhi baki hai mere dost. Now, first, understand why investing feels so confusing, so heavy, so complicated. Because let's be honest, finance language is designed to sound complicated. Sometimes it's marketing, sometimes it's ego, sometimes it is just habit. And when something sounds complicated, your brain will say, I'll do it later. I'm not good with money. What if I lose everything? So you stay in saving account or some random tips or you do nothing. Today I'm going to break this cycle for you with simple rules and some simple words. Beginners try to learn everything at once and that's the real problem. So here we are not going to learn everything at once because when you learn everything at once it's like trying to learn driving by reading a full car manual. You don't need 50 terms to understand what is finance, what is investing, how you can protect your hard-earned money. You just need to know basic 10 terms and one small action. Here we are going to do deep dive into. And how are we going to do? First, we are going to learn few terms that matters most. We'll understand how to connect those terms. And then we'll pick up one step at a time. So let's start with the first thing, which is investing and saving. Now, savings, when we say savings, it means you keep your money safe, but it can grow slowly, which is your bank account, which means today you've invested X 100 rupees, the money is safe, but it will go at very slow pace, very slow pace. In contrast to this, the term investing means the money can go up and down, but long term, it will definitely grow more. And this is through your investment in products like mutual funds, stocks, etc. So saving is for safety and investing is for your growth. So whenever you make an investment, just keep this in mind. If you want to save something for your safety, which is your day-to-day expenses, then you will save that amount. But if you're looking for your child's education, buying a new house, new car, all of those things will go in investing category. And here you will invest in mutual fund stocks, so it will help your money to grow on its own. Now let's go to next step. Risk. Risk in plain English does not mean that you will lose money. Risk means that your value of your investment will go up and down at different point in time. Maybe in short term it is going very high and then it is going down, or in long run it is giving you exponential return. So if you don't need money next month, you don't take a risk with it. If you need money next month, like if you need money to pay your bills, then don't take a risk with it because you don't know whether the price will go up or down. And if it is going down, then you would not be in position to manage it. If you want to keep your money for next 5 to 10 years, that will help you in achieving your financial goals. Then pick up something where risk becomes manageable. So longer the time horizon, your risk automatically reduces. The third term that we are going to learn is the mutual fund. This mutual fund is what we keep on hearing all the time. Now let's understand what is mutual fund. Mutual fund is like a large bucket. Many people will put money in it. A professional manager will buy shares and bonds out of this mutual fund. He will use his academic knowledge, technical skills to ensure that they pick a right stock for this basket of money that they have received. And when you buy a mutual fund, you get mutual fund units, and the fund manager will ensure that your fund, the amount invested, is growing at a regular pace and it is helping you build your corpus. In mutual fund, you don't pick stocks. The fund manager identifies which stock is suitable for your risk profile, and accordingly, they will diversify it for you. Now, let's look at the fourth term, which is SIP. SIP stands for Systematic Investment Plan. So, SIP is not an investment product. Basically, it's a method. It means you are investing regularly 100 rupees, 1000 rupees, 500 rupees, 5000 rupees every month in a designated mutual fund scheme. This SIP helps to build financial discipline. It will reduce the stress that you will experience with respect to if you have to make investing on your own. And it will also help you to average buying price over time. In simple terms, SIP is like your monthly gym subscription, where you put money every month and that money will help you grow and build your corpus. The next term is NAV, which is net asset value. So NAV is per unit, price per unit of a mutual fund. Like there is a share price for stock, for mutual fund, there is an NAV, which is price per unit. And usually the question comes like if NAV is high, should I avoid buying it? If NAV is low, should I buy it? So that's not the way NAV is interpreted. Because NAV alone does not tell you whether it is cheap or expensive to buy. What matters is whether the fund is performing, how the fund is performing in the long term. What is the quality of stock that they have invested? So I would say NAV is just a number which is representing what is the price per unit of a mutual fund. A decision cannot be made based on whether NAV is high or low, especially when you are thinking of investing. The decision to invest is most a parameter of the quality of NAV than the price point of NAV. The next is units. When you invest in a fund, you get units. These units are almost like your shares in that bucket. So if you invest rupees 50, so if the NAV of a stock, sorry, if a NAV of a fund is rupees 50 and you invest rupees 500, you get 10 units. If NAV is 100 and if you invest 500 rupees, you get 5 units. More important than unit is, are you consistent over time to keep investing in these units, which is what we call systematic investment plan or SIP. Consistency matters most than the value of NAV. Another important word term that is being spoken about is diversification. What does diversification mean? It means don't put all your eggs in one basket. Instead of one stock or one sector, you spread across multiple stocks. When you have to make a decision to diversify on your own, it requires a lot of technical analysis, fundamental analysis, knowing what is working in market, how are geopolitics factor impacting different stocks at different point in time. And all of this task is made easy by mutual fund. So mutual funds are designed in such a way that they naturally help you to diversify your stock. This reduces the chance of one bad company destroying your corpus. And even one bad company destroying the entire mutual fund is also minimized because mutual funds are diversified. Now let's look at next term, which is an asset allocation. So this is a big term, but here I'm going to explain this term to you in very simple language. How much money you want to put in equity, which will help you to support your growth in corpus, manage your highs and lows in your stocks, and how much money you want to put in debt, which will provide you stable and low return income. The decision of assigning money into equity and debt is known as asset allocation. That's as simple as that. Now, there are different ways. If you're very conservative, you are risk averse, you don't want to take risk, and you believe that I want to keep all my money safe, then increase the allocation to debt. Maybe you can make it 70% debt and 30% equity. But if you are equal, you are balanced, your day to day needs are being met, you have a stable flow of cash flow, and you want to achieve growth that will help you to meet your long term goals, then go for the balanced fund where you put 60% in equity and 40% in debt. If you are very ambitious, you want to achieve your financial target soon, you want to travel world, or you want to do lot of you want to experience lot of luxury and you want to earn money through equity route, then you may go for an aggressive asset allocation where you put 80% into equity and balance 20% of debt. The most important parameter is this asset allocation. It depends upon your goal and your timeline. Longer your goal, longer the timeline you have to achieve your goal, higher proportion into equity is still comfortable. But if there is an immediate need to make those payments, then it's better to keep your money in your savings so you can meet your day-to-day needs. Return versus CAGR is the next term we are going to discuss. Return means how much money you are earning based on investments that you've made. So if you have put in 10 rupees or 100 rupees in a investing product, what is the value of that product at the end of year one, year two, year three? The value at the end of each year is the return that you get from this product. CAGR is a compounded average growth rate, which is just a way of expressing your average yearly growth over time. You don't need to calculate it on a daily basis. It's usually on an annual, monthly, semi-annually, half-yearly, fortnightly. There are different ways in which you compute your compounded average growth rate, which is called as CAGR. The objective of this is to have a longer time horizon so that your money can compound over a longer period of time. Here I would say, keep a simple rule for yourself. Don't chase highest past return. Past, they would have demonstrated that return, but now what you have to do is you have to chase a plan that you can follow for years and it will help you to achieve your financial goals. Last and the most important term that I'm going to introduce you and explain you today is called expense ratio. So mutual fund, they charge small fee to run the fund, and this fee is known as expense ratio. The lower the ratio is better because higher amount of your invested amount is helping you generate return. Because lower fees, which means more amount of money that you've put in the fund is being invested into different schemes of fund that will help you in a longer run. A slightly higher fee is okay if the fund quality is strong and consistent. The fund quality is not strong, then better go with lower expense ratio. So when you're evaluating fund, ensure that you select a fund that has a lower expense ratio. Slightly higher is okay if the fund quality is excellent and they have been very consistent in their performance. So here, I would say, let me explain you how all of this connects. We've discussed about 10 terms, but let us see how all of these terms are connected to each other so it stops feeling random to you and you can make this decision. So how do you start? You start with your goal and a timeline for the goal. So your goal may be that you want to achieve financial freedom in next 10 years and The goal may be that you want to achieve your financial freedom. For that, you need corpus of 5 crore and you have timeline of 10 years. So that is how you have decided to on your goal and timeline. Next is that you have to decide on the allocation. How do you want your current asset allocation to be that will help you to achieve your goal in period of 10 years? So today, if you have a stable state of income, then you would not need lot of expense for your day-to-day emergency needs. And in that case, you may go for higher equity allocation, or if you have immediate business, you can go for balanced equity allocation or a conservative, whatever is your current financial situation and your goal. Based on these two parameters, you decide your asset allocation. Once you're clear with this, you pick up a mutual fund that will match this criteria. Once you select that fund, then you decide to stay invested in the fund through systematic investment plan. You can create an auto debit setup for your systematic investments, and then each month the amount X amount which you will decide will get deducted from your account, will get automatically invested, and you will get units against those NAVs. When you select fund, it is your responsibility that you select a mutual fund that helps you to diversify your risk. And then you keep on tracking the return that is being generated by this fund over a period of time. You know how fast your investment is growing. And when this is growing, the expense ratio is something that you have to keep a tab on, whether the expense is ratio is going up, down, and how it works. So this is how this entire 10 terms that we discussed are being linked, and how you have to think when it comes to making a decision for your financial goal. So to make it simple, identify a goal with a timeline, determine your allocation, pick X amount from your current salary and do SIP on a regular basis, and stay invested in that fund. I would say don't overthink, because it so happens that there are so many products, so many jargons that we go in the zone of overthink. Ensure that you pick up a one goal as of now, whether it is your emergency fund that you want to build, so you don't have to worry about it at any point in time, whether it is about your child education, your house down payment, or your retirement. Any goal that you have, just pick one goal and pick a timeline. The timeline is 0 to 2 years. It's mostly the safer option that you would want to take. If a timeline is 3 to 5 years, then you would take a mix of that and but if a timeline is more than 5 years, then you can definitely go for a equity heavy investment, because then you will get a compounded return from those investments. Then I would say start with small SIP, maybe 500 or 1000 rupees or 10,000, whatever is your comfort level. It is not about the amount that you invest, it is about the habit that you build. Once you have built this habit, you track it on a monthly basis, not daily. Because if you track it on a daily basis, it will just give you panic. Track it on a monthly basis. The patience will help you to stay invested in this product for a long run. Here, I would say whether you're feeling overwhelmed or confused, that does not mean you are bad with money. It means that these are the terms that nobody has explained you in the way that will help you to make decision. I would urge you to again go through this recording and understand how you should link all of these factors so it's easy for you to understand and implement this concept. पर picture अभी बाकी है, because now it's the time that you start small, start building confidence and grow. Stay consistent in this journey. So let me know how did you find today's presentation, and if you know any of your friend who are struggling and who does not are not able to make this decision, then please share this presentation. Please share this link with them so it helps them to understand and helps them to make better financial decisions. I'm on a journey to make financial learning easy for all of you. Let me know in comment section if there are any terms that you would like to learn or understand that is stopping you from making any investment decision. Thank you for watching. coming again with a lot more interesting content.